is what is inflation and what the heck do interest rates have to do with inflation? All right, thanks for joining us, episode 3. And we're going to jump in and
talk a little bit about inflation.
So big questions that we want to answer today is what is inflation and what the heck do interest rates have to do with inflation? Like, there's a lot of conversation about the Fed, about them raising interest rates, and this is all because of inflation, and it just doesn't make a lot of sense if you don't understand the machines at work here. So let's start with a little story. All right. So in 2017, true story. In 2017, I bought a house. I used my VA loan. So that's very important. With the VA loan, I did not have to put a down payment. So we're talking about sole financing here. No equity out of my account into the cost of the house. So I bought the house. I financed $350,000. I locked in a 2.75% interest rate, and it was a 30-year mortgage. My monthly principal and interest payment was $1,429, right? So again, $350K, 2.75% interest rate, my principal and interest every month, $1,429. The total cost of that loan, so paying off the house and then paying for the financing over 30 years, I would have paid a total of $514,000, right? And that's not bad, because if you think about a $350,000 home, paying for that home and the mortgage and only having to pay a total of $500,000, how much is that home going to be worth in 30 years? Yep. Probably more than $500,000, right? Well, it is, because now we're in the future, and it's only 5 years later, and so we're going to get to that. But 2.75%, $350K, those are good numbers. Let's look at Zillow. So I pulled up Zillow, that property today, and that property today, according to Zillow, is worth $552,000.
So it's appreciated $200K.
It's appreciated a little over $200K in 5 years.
Yep.
All right. So what happens now if I want to buy that same house? And we're just going to compare apples to apples here. So I'm going to use the same terms we used in the real life scenario, but buying it today. So in this case, if I financed $552,000 for 30 years at 2.75% interest, my mortgage now is $2,250 a month, right? My total cost for that loan is $812,000, right? So the house payment went up about 150%, a little over 150%. That's my monthly principal and interest payment. The total cost of financing went up by about $300K, right? And that's all because the property value went from $350
to $550
to $550, right? Okay. So that's crazy. But the problem with that math is we can't get a loan today for 2.75%. Right? So now let's redo this math again in actual today terms with actual today interest rates.
This will show you how bad interest rate, or just
how much it affects, right? So in this case, assuming everything is happening today, and I'm making all the decisions today that I made back in 2017, I'm now looking at a house that I need to finance $552,000. The average interest rate today, according to Forbes this morning, an article came out this morning, the average interest rate that people are getting approved for on a 30-year fixed is 5.27%. So we're going to run with that number. So financing $552,000 at 5.27% for 30 years, my mortgage payment, principal and interest, ready for it? $3,050.
So it doubled. A little bit more than doubled.
It more than doubled. And the cost of financing and the cost of the home combined over the next 30 years, I'm going to pay $1.1 million, a little over that. So again, what I did buy at $350K, 2.75% interest, total cost, a little over $500,000. Now, at $552,000 at a 5.25% interest rate, a little over $1.1 million.
Mm-hmm.
Things have gotten insanely expensive.
Let me ask you this: with this going up the way it's gone up, do you think wages have kept up?
So we did see some great wage increases last year, actually, but no, they don't.
But not this much.
But not this much, unfortunately. Things are just getting more expensive. So, what is inflation? And what do interest rates have to do with it? Well, I think right there, and we'll kind of get into the weeds a little bit, but right there you can see that inflation in and of itself is a decline in purchasing power because things are getting more expensive. Inflation equals things getting more expensive, right? Mm-hmm. The way interest rates work, right, is if things are getting more expensive and I'm going to charge you more to borrow money to buy them, now all of a sudden you're going to think a little bit harder. It was a no-brainer for me to buy my property in 2017 for $350K at 2.75% interest. Now at $550K at 5.27, I might be like, I don't know. Yeah. What's crazy though? 5.27% interest. That's still a good mortgage.
That's not a bad mortgage.
That's not a bad mortgage. We're spoiled, right? That's recency bias, which we talked a little bit about last podcast. So what's going on? What is causing inflation? Why is it happening right now? And we're going to move backwards through some recent events, from most recent to kind of a couple years ago. Talk about what's going on to drive inflation. We're going to move through this pretty quick. But most recently, we have a couple things going on that is really disrupting we'll call it the normal function of the globe, right? Russia and Ukraine are in a war, and it's like Russia and Ukraine are pretty important to the global distribution of goods.
Major exporters.
There's a lot of things that come out of both Russia and Ukraine that are important to all of us, and it's caused, like, basically we're kind of in panic mode trying to restructure the global distribution of goods because we can't rely right now on Russia and Ukraine with what Russia is doing to Ukraine. So that's causing some instability, and especially like things like oil, right? Things with wheat, different kinds of grains that come out of Ukraine. That rhymed. The other piece to this is China has this zero COVID kind of principle philosophy thing that they're trying to execute on. It's really unattainable, but what it keeps doing is causing them to shut down major areas of China. And so as much as China produces in goods for the world, every time they shut down, there's nothing new getting made. So shelves are going to be a little more empty for a little while. What we're driving, the common theme here is that when we're talking about supply and demand, we're not talking about crazy, insane demand as much as we're talking about just terrible, lacking supply of things that we normally have access to. It's easy to remember the toilet paper crisis, right? There was no toilet paper. Everybody was in a panic. We've seen it with lumber. Right? There was a panic for lumber for a short time. I think it was like 1,700% that lumber increased in price. It fell pretty quick. It re-regulated itself, but it took a few months. And now it's still a little bit more expensive than it was pre that inflation jump thing. So with everything going on, we're really running into some supply issues. And this kind of all is a big long-term effect of the COVID shutdown. And we're not here to talk about the rights and wrongs of politics. We're just talking matter of factly
what's happened.
that when we shut down the globe because of COVID, we were turning off this really complex, finely tuned machine that is our supply chain.
Yep.
Right? Companies, for a long time, we've practiced just-in-time supply. We don't have a lot of inventory buildup. There's a whole lot of stuff like that plays into some of the breakdowns we're facing now. But I liken it to my first car, 1986 CJ7. It was a Jeep, and it had a carburetor. And in the summertime, I could crank the key and go. Mm-hmm. Like, it was pretty easy. Let it warm up for about 10 seconds, and I was off to the races. In the wintertime, that carburetor spring would be too cold to work right. So I'd have to go in and try to start it and then pop the hood and, mess with the spring and kind of open up the little
the
flap.
Yeah.
I'm not a car guy. It's embarrassing. But I'd have to open up that and eventually let the car run on kind of a high idle until the engine warmed up, and it'd warm up that spring.
You just hit the gas, and
then I hit the gas, closes back, and now I'm good. But it took longer, and that's kind of supply chain is not an easy machine, and we can't just turn it on and off. It's not a light switch. So yeah. So anyway, the carburetor I think is a better analysis to what a better visual aid for what supply chain is, and we shut it down, and it started to rust over a little bit. And we just were coming in one day expecting to flip on a light switch, which we can do for the consumer. If you say, "Hey, consumer, you can start flying again," they're going to go fly again.
Right. Yeah.
Right. They are like we are more.
There's a lot of pent up demand right now, and we're seeing it.
Yeah. So that's what's going on. Supply shortages. We also were seeing labor shortages for a short time in the ports. A lot of ships were getting backed up because they couldn't offload their containers. The container yards were getting full because there weren't enough workers. There weren't enough truck drivers. Like, it was just all kinds of craziness. We'll revisit that in a second when we talk more about the actions we can take to get out of this. But there was worker shortages. Climbing oil prices. The higher the oil, the more it costs to ship goods. The more it costs to ship goods, the more the good manufacturers need to charge to make sure that they keep their profitability going. The more that the end seller needs to pay for goods, the more they have to charge to keep their profitability going. So from point of origin, that raw good, to consumer the thing that we're buying on the shelf, there's a little bit of a markup along the way, because every time that raw good gets transported, or the production facility makes the good and transports it to the shelf, like, there's cost, and they're higher now. So there's just this kind of like perfect storm of things that are not going well. And it's not just oil, right? There's other commodities. We're seeing this. I mean, even right now, there's the baby formula shortage, which is super scary for people that need to rely on baby formula.
So what's going on now, or what is the Fed doing to correct, or to attempt to correct all of this?
So with inflation, the assumption is the Fed can fix it with the tools they have. It's really important to understand that the Federal Reserve is kind of this independent, autonomous piece of our economy and government system that basically has two critical tasks, right? They need to facilitate employment, right? They want to keep people working. And they also need to facilitate a healthy range of inflation, which is typically around 2.5% is kind of their goal. If we can sustain about a 2.5% increase on goods over time, and wages see about a 2.5%,
you're going to have stable.
It's stable.
Stable
Things
economy.
are good. So in this case, the problem with that is their two primary jobs are really in conflict with one another, because for me to sustain a healthy unemployment rate, right, it means that I need to keep demand high enough for companies to need workers. Well, if demand gets too high and supply isn't there, Now as the Fed, I need to crush or squash or curb demand, reduce demand. Well, if I reduce demand by just a little bit too much, now now corporations don't need the workers they needed when demand was high. So there's layoffs. So in order to fight inflation, I need to reduce demand. But if I reduce demand, then people get laid off. And my number 2 job that's equally important is to keep unemployment at all-time lows or as low as possible, right? So they really have this conflict in what they're trying to accomplish. So that's just kind of one really critical piece to understand. However, if we want to talk about the tools the Fed has to just fight inflation, there's really 2 things that they can do. One is increase interest rates,
which is what they're doing.
Which is
what
they're
they have
already
been
doing it, right? And we talked about that with my house story.
Yep.
You know, again, if I can get money loaned to me, if I can get $350K loaned to me at 2.75% interest, that's great.
A little easier decision.
At 5.2%, it's still good, but now all of a sudden I got to think about it a little bit more, right? So again, when it comes to demand and supply, that house that I was dying to buy at 2.75 is now a little bit more of like, hey, maybe we'll wait and see a little bit. So it sits on the market a little longer, right? So now the demand is a little bit less. Supply starts to regulate, starts to come back up. So now there's a balance of supply demand. We're actually already seeing some of the evidence.
We're slowly seeing that around Nashville.
We're starting to see it kind of around the country in a lot of areas. It's still too early to tell if we're on like a trajectory towards beating this inflation, or if it's just kind of one-offs here and there, and we'll kind of have to, ease our way into it over a longer period of time. But we are starting to see that just the couple interest rate hikes that we've been through with the Fed over the past couple of months is actually starting to
somewhat of an impact.
Now, the other piece that the Federal Reserve the other tool that they can use is their balance sheet. And the way this works is the Fed looks at buying things like treasuries and mortgage-backed securities. And when they buy them, when the Federal Reserve buys these assets,
that's putting money
they
in the bank's
take
pocket.
Assets out of our economy and put it on their balance sheet, and they take money off of their balance sheet and put it into our economy, right? So again, now there's less of a supply of, say, treasury notes out there, right? So now if there's less, I don't need as much demand, so I can reduce rates and things like that on treasury notes. And more money's out there for you to go and buy physical assets or stocks and equities, invest in companies, all that stuff that stimulates growth. Now what happens, and we're actually in the first month where the Fed is going to do this today.
And they're cranking it up.
And and it's going to phase into a quite a big runoff.
Oh, they're going higher?
Yeah, I think. What were the numbers? I was like around 45.
I know 95 million is what they're
billion
a month.
Yeah, and then it's going to go to
billion. Sorry,
it's like 47. I think they're doing half for the first few months, and then they're jumping up to the 95 billion. I think by this fall. But basically, when they sell the assets, which is what they're doing, right? They're going to sell the assets back to the market. That means the assets are leaving their balance sheet and going back in the economy, increasing the supply. So we have to increase demand by raising rates. And the money is coming out of the economy back to their balance sheet. So now there's just less money out there for us in the economy. So money gets a little bit more difficult. Again, so there's a whole balance of, it's really complex. We could spend probably months talking about this every day. But understanding that really the Federal Reserve can raise or lower interest rates. If they raise interest rates, demand comes down. If they lower interest rates, demand goes up. They can also buy and sell assets, things like mortgage-backed securities, things like treasuries. And when they buy them, they're putting money into the economy. And when they sell them, they're taking money out of the economy. And so the Federal Reserve is already implementing the critical takeaway
tools that
here.
they can use.
They're implementing the tools already. Okay. So if we're already on our path to fixing this stuff, why aren't we just like feeling better about the way things are going? And the reason why is because when the Federal Reserve acts, it is very rare. It has happened, but it is rare that they can get through these inflationary periods without overdoing it
And causing
crushing
inflation.
demand a little bit too much and turning inflation into a little bit of a recession, right? Or a lot of a recession. Who knows? That's the fear. So if you're watching the news, you're like, oh, the Fed's raising interest rates. We have inflation. Well, how the heck do that? Now you know how those correlate.
Right.
The Federal Reserve is working to reduce demand so supply and demand can balance.
And I think our society expects things to happen so fast
This is a
that with
process.
inflation, with them raising the rates and reducing balance sheet, that takes time.
Yeah.
Like it's going to take time for this inflation number to drop to where they want it.
It's
and
tough.
I think their goal is 2.4%.
Yeah.
Is their target.
Yeah. So the question is can the Federal Reserve thread this needle to combat inflation, keep unemployment low, and keep us from doing too much demand destruction that leads us into a recession? The beautiful piece about this, to your point, is it takes a little bit of time to tell. And I will say this, I'm not overly optimistic about everything in life, but I will say that there are so many people who try to predict the end of this world every day, and they get so much airtime. So you really have to understand that we have time and we have to wait and see. So panic is not an option. Like you don't execute anything with your financial portfolio or financial well-being based on panic. And that could be anything from managing your assets. That could be anything from like, oh man, I got to buy a home. Interest rates are about to skyrocket. Like, no, don't panic buy, right? Let's apply some things, some logic, some reason, and some historical examples and say, hey, okay, so here's like in the Army, we would always do what's most likely to happen, what's the most deadly circumstance, right? And what's the best circumstance? So what's the best, what's the worst, and what's most likely? That's what I need to know to make good decisions. And we can apply that same kind of thing for us, right? In these kinds of things. So and again, the good news about this, and what I think another critical point to understand, is of all the things going on, markets being off their highs, volatility going on, you can't get the Republicans and Democrats to agree on anything in Congress. All these things, Russia, Ukraine, COVID, all these things going on.
A lot of bad news.
What is the worst?
Right.
If it doesn't get taken care of fast is inflation for people's financial future, right? You wrote down some losers. What was the...
Yeah, so... when you're dealing with inflation, you've got some losers, which are going to be your savers, your retirees living on fixed income, your workers on fixed income, and borrowers that have variable rates.
Yeah, so that being right there, the biggest piece I think when I read that list that you wrote was retirees relying on fixed income, because all of a sudden, if inflation continues, they might need 20% more in their monthly paychecks from their investments to offset the cost of life. And so if this gets left undone, your portfolio being down 10, 15, 20, 25% even in the short term, while we wade through some of these problems and see these fixes be implemented and see the outcomes, that's a short-term problem.
Right.
And if you're a long-term investor, your dollar cost averaging in, this is actually fine for your financial future. It's not fun, it's fine.
Right. It's giving you an opportunity to buy things at discounts.
For the person on fixed income.
That's already retired.
If inflation gets left unchecked, that can be derailing. Right. And so we have to fix inflation. We have to endure the hard thing, the temporary thing that we're going through in the markets to make sure that we squash them. That has to be the highest priority for our, economic leaders around the globe. And so I think that's just really, really important to understand. The Federal Reserve is doing the work they need to do to combat inflation in the United States. It's already showing to have some effect. We have a little bit further to go, but I think the narrative will start to change. A recession is not a guarantee for us because of this.
Right.
I can almost it's pretty probable that we will go through a recession again in our life. That's just part of the story. We plan for that. But in and of itself, we don't necessarily need to assume that we will have a recession this year because of inflation or because of the Federal Reserve. We don't even need to assume that we will have one next year because of what we're going through. Is it possible? Does the possibility increase a year from now? Sure. Right. But if you have a plan and you're paying attention to all the components of your financial vital signs, then you're going to know, hey, a recession only, when we'll have a call, we'll do another video about inflation specifically, or about recession specifically. Yeah. But if you understand what a recession is, it's just not that. It's not fun, right? But it's fine.
The folks on the news make it sound a lot worse.
Yeah, because it's doomsday every day, every time's the last one.
But the bottom line is that people need to understand is it's healthy for an economy to go through expansion and contraction.
It's part of the process, and
it's part of it. It's part of a healthy market.
Yeah.
And we might be going down that into the contraction part now, which we are. But that just means there's an expansion coming right behind it.
Right. I think that understanding that the supply and demand balance is just a little bit tilted, and all we're doing is rebalancing that through Fed action of raising interest rates, making money a little bit harder to get. You have to think, it's not impossible to get. You just have to think about it a little more. It's more costly. And then the other side of that is the buying and selling of assets the Fed can do to put money into the economy or take money out. But I'll say this too. There's a whole nother set of tools that our Congress and White House can also put into practice. And we're just not seeing a lot of action. So while the Fed is being criticized in the news, like if you watch the news, you're going to hear all about Fed missteps and they
waited too long.
Yeah, waited too long. It's not, inflation wasn't temporary. The problem is we're not hearing a lot of talk about, I know that the White House did this inflation task force. I've yet to see really any kind of decisive action come out of that.
What have they done? Yeah.
When we talked about the ports being backlogged, an action that the White House did take was they activated some National Guard truck drivers to go to the ports and move
supplies,
containers out. That is a congressional or a presidential order that can take place to also. So the Fed can really only dampen demand.
Right.
I don't think the focus needs to be overly or only placed on reducing demand. We could also do things through infrastructure reform, infrastructure bills. We can do things, like everything from, making sure the commodities of goods are getting imported correctly. We have a lot of, tariffs on countries around the globe that make shipping, importing into the United States a little more costly. We could see the president cut those costs, the cost of shipping. And so there's a lot of things that president can do, that Congress can do. The problem is nobody can agree in DC on anything. And that's really sad because right now,
and it's hurting
there are people that live paycheck to paycheck. They don't make a lot of money. It's really tough. It's really tight. Everything's painful. And then seeing, rent go up 25%, seeing gas prices double, all these things hurt. By the way, there's a shortage of baby formula. So if you're relying on that for one of your kids and you're living paycheck, good luck. We need to see a lot more congressional and presidential action to help with the supply side of things. And I think that's the whole story. That's the complete story. The Fed's doing a lot of work. They're a little late. There's a lot of criticisms for the Fed that are accurate, right? But the problem is they are now doing the work and they are reducing demand. Let's see some more legislation and presidential action to increase supply and regulate supply, not just here in the United States, but globally. I think that's the whole story. So I really just say that inflation, again, supply-demand imbalance, things get more expensive. It's not fun, right? How would we beat it? The Fed reduces demand. Congress can increase supply. And also corporations can increase supply. It takes time, but it can work. The supply chain will fix itself over time. We'll get rid of these shutdowns, or at least on a regular basis soon. So
but overall, they're taking the steps.
We're working through
to stabilize it.
Yeah, but hopefully now, anybody listening to this, the tens of people that listen to this right now. No, I'm just kidding. Maybe we have millions. I don't even know yet. But for all the people that do listen, the goal was, what is inflation and how the heck are interest rates a part of this narrative? Hopefully now you realize it's just about demand encouraging, like demand increase or demand destruction, right? The Federal Reserve says, hey, what do we need to do right now? Because of inflation, we need to destruct demand. So how do we do that? We make money tighter.
Contract the economy.
We take money out. We make it cost more. And now interest rates, we're going to raise those too. And there's so much depth into this, and we could go into it. If you guys have questions, I love talking about this stuff. We can talk about Fed funds rates and bank borrowing, and we can talk about overnight lending. We can talk about all these crazy things and how it's just this crazy complex ecosystem of money. But most people don't care, and we'll just yawn if we get into that. So we're not going to get that deep, but understanding we've gone through a lot. The chances of us getting through this in like the series of things that we've gone through, the chances of getting through this perfectly is almost zero.
Yeah.
The next question is, how do we respond? And some of the responses happening, I would love to see Congress and the White House take more action on the supply side, because I don't want to see demand go away. I don't want to see people get laid off. I don't want to see all those things. I understand regulating it, and money's been too free and too cheap for too long. We've been spoiled. Yeah. Let's go back. And that's also just one really critical piece on kind of a sliding scale. You have like basically cheap money, then, easy policy. And then you have in the middle, normal policy. And then on the other side of this scale, you have tight policy, right? So in the sense, we've been in this easy world
for a while.
Yeah. And the Fed's goal is to move us back to normal. Right?
Yep.
They said a couple times that they might have to go a little past normal on the scale, but they want to eventually go past back.
Normal to get us down to that.
But then they're going to come back. So we might be able to look ahead and see some rate cuts. We might be able to look into the future and see the Fed not selling assets, right? Or maybe even buying assets from time to time. So it's a sliding scale. What's different this time than a lot of times in the past is we were in a normal policy when inflation started, and we had to go too tight, and that was really painful, right? That's monetary tightening at its finest definition. While we are technically tightening because we are moving from where we are towards the center, we're not in the center going to tight. We're in the easy going to normal. Yep. And I think that's really, really important for just...
That'd be a great lineal scale to draw out for people.
Probably should. But I think that's really an important piece to this is just understanding the narrative, putting things in perspective, that like maybe the doomsday scenarios, maybe we can thread the needle because we are going from easy to normal. We're not going from... It's not overly complex. It's just hard. And it's not fun, but it's fine. And again, if we're focusing on all 12 pieces of our financial health, we understand there's a bigger story here, and it's a long-term game. And inflation can derail a long-term game, but we're not trying to. We're trying to beat inflation, right? Mm-hmm. So in this, the volatility, the market's correcting, going through maybe even a recession.
Right.
That's a temporary story, and if you have the plan in place, I can almost bet your financial planner has already planned for recessionary time periods, deflation and inflationary time periods. We build that into the long-term plan. We know there's going to be great years. We know there's going to be really bad years. So we plan for all that. We're at 34 minutes. Let's go ahead and wrap it up.
Good deal.
Any parting words?
This is episode 3.
Episode 3 in the bag.
In the books.
Inflation and what the heck do interest rates have to do with it? Yep. Thanks for listening. love for you just to subscribe so you get little alerts when we post new content. And
check out our
send
website.
It out. Tell a friend. Yeah, we'll talk to you soon. Thanks.
We hope you learned from our conversation today. It is important to us that you know this is for educational purposes and not intended to be considered specific advice for any individual listener. If something we discussed is relevant to you and you have questions of how it might be applicable to your specific situation, please reach out to your financial professional. Of course, we are happy to have further conversations with you regarding specific questions or applications to your individual financial situation. With that, here are a few disclosures. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Harpeth Wealth Partners are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hypothetical examples presented are not representative of any specific investments. Your results may vary. With that, thank you, and we look forward to having you back. Take care.